Stop. Before you hit that buy button on any ETF, ask yourself this. Are you investing to build your future? Or are you just volunteering to hand over your profits to fund managers? Most people believe ETFs are the ultimate safe haven for their money. But the cold, hard truth is, there are silent killers quietly draining your account every single day without a single warning. In this video, I'm going to expose the 7 lethal traps that 90% of new investors fall into. Don't let a lack of knowledge turn your hard-earned savings into a zero. Let's dive in. Mistake 1. The illusion of diversification. The first mistake, assuming that every ETF is automatically well-diversified. Many investors believe that simply buying a fund means they've perfectly spread out their risk. But the reality is, not all ETFs are created equal. Look at the healthcare sector. The XLV fund holds only about 65 stocks. More alarmingly, the top 10 holdings alone account for 50% of the entire fund's weight. If a single giant like Pfizer hits a crisis, your entire investment will plummet. The lesson? Don't just judge a fund by its name. Check the top 10 holdings first. If 10 companies represent more than half the value, that isn't diversification. It's concentrated risk in disguise. Mistake 2. The safe haven delusion. Many new investors whisper a dangerous mantra. Buying an ETF is 100% safe. Let me be clear. This is a deadly misconception. While ETFs eliminate company-specific risk, they are completely powerless against systematic risk. In 2008, the S&P 500 lost a staggering 50% of its value. In 2020, global markets wiped out 30% of even the most diversified funds in weeks. The biggest danger isn't the red numbers, it's the psychological warfare. When investors panic and sell at the very bottom, they turn a temporary dip into a permanent loss. An ETF is a long-term vehicle, not a magic shield. Mistake 3. The silent heist of fees. This is the most legal and slowest heist in financial history. Most investors shrug when they see a 1% management fee. They think, it's just a tiny fraction. They are wrong. Imagine you invest $100,000 over 30 years. With a 0.1% fee, you end up with $1.69 million. But with a 1% fee, you are left with only $1.32 million. That tiny difference just wiped out $370,000 of your wealth. Fees are not just costs. They are your future profits being siphoned away. Always prioritize passive ETFs with the lowest expense ratios. Mistake 4. Ignoring the tracking error. The index goes up 10%, but your fund only goes up 8%. Where did that extra money go? Welcome to the world of tracking error. This is a performance leak caused by high costs, delayed rebalancing, or poor management. A large tracking error is a glaring warning sign. It means you aren't just losing money, you're being robbed of the performance you paid for. Don't settle for a lazy fund. Mistake 5. Chasing the ghosts of the past. Never drive a car by only looking through the rearview mirror. Past performance is the most seductive trap ever laid for beginners. Just because a fund skyrocketed 50% last year doesn't mean it will happen again. Often, by the time you see those massive green bars, the party is already over. You aren't investing. You are providing exit liquidity for professional traders. Don't let a shiny return blind you to a mediocre future. Mistake 6. Outsmarting the market with timing. Trying to time. The market is a game that even Wall Street geniuses lose. If you miss just the 10 best performing days of the market over the last 20 years, your total returns would be cut in half. Stop playing a guessing game. Use DCA, dollar cost averaging. Invest a fixed amount every month regardless of the price. Remember, Time in the market is far more powerful than timing the market. Your future self will thank you for being disciplined, not lucky. Mistake 7. The leveraged ETF nightmare. Finally emerges the most dangerous trap: leveraged ETFs. These are weapons of mass destruction for beginners. They are designed for day trading only. Due to a phenomenon called volatility decay, these funds reset daily. If the market just bounces up and down, your leveraged fund will still be deep in the red. If an index drops 10% and then gains 10%, a 3x leveraged fund needs a 43% gain just to get back to zero. Stay as far away from these as possible. Don't let greed lead to a 100% loss. We've covered a lot today, from the illusion of diversification to the hidden traps of leveraged ETFs. You now have the knowledge that most investors only acquire after losing thousands of dollars. Investing in ETFs is a marathon, not a sprint. It's about discipline, patience, and understanding the numbers behind the charts. Success doesn't come from finding a magic fund. It comes from avoiding these 7 lethal mistakes and staying the course. Now I want to hear from you. Which of these mistakes surprised you the most? Or are you currently holding an ETF and wondering if its fees are too high? Drop a comment below. I read every single one, and I'm here to help you navigate these shark-infested waters. If you found this video valuable, do me a favor. Hit that like button and subscribe. It tells the algorithm that this kind of financial education matters. Share this with a friend who's just starting their investing journey. You might just save them from a very expensive lesson. Thank you for watching. Stay disciplined, stay informed, and I'll see you in the next video. Your future self is counting on you.